So we had a huge spike on open today, but it seems like the markets for the most part are giving most of it back. We had the NASDAQ up over 4% today, 4.5%, and now it's green by about 0.85%. So we've given quite a bit back, and the mid-afternoon slide continues here. Now, the reason I'm making this video today is primarily to try to kind of put some perspective on investor expectations during these types of market situations. For some, this will be the first ever bear market they've went through, and we are officially in bear market territory, especially when it comes to the US indexes, not so much the Canadian indexes. However, even if you've been investing for the last 5 years, you might have a bit of an expectation when it comes to a bear market and the overall recovery time, along with a bunch of other misconceptions that are often brought in when it comes to equities. So in this video, I do aim to kind of shed some light on some perspectives you should have heading into this bear market, which will ultimately allow you to not only navigate it better, but set yourself up for stronger returns in the future. For those of you new to the channel that don't know who I am, my name is Dan Kent. I am one of the founders of Stocktrades. We're one of the fastest growing investment websites in the country. And I also host the TCI podcast, which is a twice a week investment podcast. You can follow that over on Spotify. I do that with Simon Belanger. It's an excellent podcast. Will give you some very strong insights in terms of news, investment strategies, things like that. And if you do appreciate the type of content we provide here, head down below, like the video, subscribe to the channel. We're on the path to 20,000 subscribers. I'm hoping I can hit it pretty soon, but as always, the support helps. And it also lets me know if you appreciate videos like this, and I'll continue to make them. If you want to join the newsletter, 25,000 subscribers get it every single week. Plus, you'll get a bonus report of 3 of my top options in terms of stocks in 2025. That's in the description. It's absolutely free, and it just takes a couple seconds to sign up for. But let's dive right into the video and kind of go over how you can manage your expectations in this bear market to come out way ahead and often better than the vast majority of retail investors. So I would argue one of the biggest flaws I've seen from many investors, particularly those who are new to the market, is the expectation of a quick recovery. If we pull up the bear markets that we've seen since post-World War II, we can see a wide variety of recovery times. We can see back the post-World War II recovery, it took 22 months to break even if you had bought at the peaks. We fell around 29%, which is still quite a big drawdown. I mean, it would have been the biggest drawdown they witnessed in the last 20 years. Moving forward, obviously the Great Depression would have been much more nasty. 1973, we saw a huge bear market. This would have been the oil crisis in the mid-70s, a lot of embargoes, things like that. The market fell 48%, and it took you almost 4 years to break even. And when we fast forward to the more recent bear markets, and probably ones that a lot of investors are going to, even if you're a newer investor, are going to be fairly knowledgeable about, we're looking at the tech bubble in 2000. This is when pretty much anybody with a domain name could have gone public, had very little revenue, and were trading at absolutely absurd valuations. Obviously, when we get to bubble-like conditions like that, you're going to see large scale backs of the index. I mean, we're looking at a 31-month bear market, 3 years. And then we're looking at a 53-month recovery. So if you bought, it would have taken you 4.5 years effectively to get back to your break-even point if you had bought right before the crash. So financial crisis was obviously one of the ugliest ones of all time. Why? Because it was very quick, 17 months, and we're looking at a substantial drawdown, 57%, and it took you similar time to break even. We're talking about 53 months. And then we get to the most interesting ones, and the ones I want to talk about. We're looking at the COVID crash. We're looking at February to March 2020, and this lasted 1 month. I remember I was actually on vacation in Nashville when this happened, and as the market started to crash, I was tuning into the news pretty much every day because we were wondering if we were even going to get home from Nashville. And, you know, cruise ships were getting shut down, flights were getting canceled, things like this. This virus was spreading. It was going all over the place. And I watched my portfolio fall. I believe it was 30% in a couple of weeks. It was absolutely brutal, but it was fairly quick to recover. And why was it quick to recover? Well, for one, the COVID-19 pandemic, it was not as bad as perceived, and I'm not speaking on any sort of health situation here. I'm solely speaking on the impact on the economy. However, there was another element of the fact that this was not as drastic as it could have been because of substantial stimulus by many governments around the world in an attempt to support small business, support consumers, manage the unemployment rate, things like that. If the government had not have stepped in, this would have been ugly. It would not have been a 4-month recovery time. I can guarantee you that. They injected a absurd amount of money into the system. They dropped interest rates to practically zero. And they held them there for quite some time, which caused a absolute surge in economic activity. People were locked down. They didn't really have, anything to do but to sit on YouTube, to buy stocks, things like that. So the market recovered fairly quickly. And then we head to January 2022 and October of 2022. And this was a relatively quick bear market by standards as well. We're talking about a 9-month duration. We're looking at a 25% drawdown and a 13-month recovery. Now, this was primarily driven by supply type issues when it comes to inflation, and this is also due to the stimulus that they provided during the COVID-19 pandemic, which ultimately skyrocketed inflation. However, this was relatively quickly managed by some of the fastest rate increases in history. So in that regard, this bear market was relatively quick as well. Investors really didn't realize that much pain. So if you started investing in 2020, you really have not hit an environment that has been very brutal. So your expectations might be for a quicker recovery. Now, if we look to this particular bear market, which is tariff related, global trade, things like that, the federal government does not really have as many levers to pull as it once did. If we look to 2020 and we see that economic stimulus, I don't believe this is something they can do again if the economy were to get harsh enough. Why? Because it would likely cause more inflation moving forward over and above what the tariffs would cause. And when we're sitting at policy rates that are high and we get high inflation, this also takes away another lever they had in 2022 where they could raise interest rates huge because of how low they were. I mean, if you can imagine if tariffs cause inflation, unemployment rises, the government looks to be providing more stimulus, things like this to maybe companies impacted by tariffs, we could very realistically see inflation rise again. And what are they going to do? Get policy rates up to 6 or 7%? I don't really think that's feasible in today's economy, and they really don't want to be doing that. So in terms of the situation we're in right now, it is likely if tariffs persist, this bear market would linger a lot longer. And I do think it is very important to manage expectations in terms of recovery time if it persists. Now, that said, if tariffs go away, if deals are negotiated, things like that, we could very well see a quick recovery time. But if you're buying equities right now with the intentions that they're going to rebound over the next, 4 months, 6 months, things like that, you're taking the wrong approach into this, because ultimately, if they don't, you're going to start modifying your strategy because you've based your thesis on the fact of you're buying stocks now. They recovered quickly during COVID. They recovered quickly during 2022. So they're ultimately going to recover quickly now. This just isn't the case. And ultimately, there is zero question as stock prices get lower, our future expected returns get higher. But where you're going to be tripped up is if you expect these returns to be realized over a 6-month time period, a 1-year time period, a 2-year time period. If these tariffs persist and we hit a global recession, you're likely going to be entering a situation where equities trade at lower prices for longer durations of time. I mean, if we go back to that chart, there's been numerous times where bull markets last for multiple years. So don't get the idea that your equities are just going to spring back into action over the next 6 months, 12 months. If they do, amazing. But just don't take that expectation into the market, and ultimately you should welcome lower prices for longer. It will allow you to accumulate stocks at lower prices for longer periods of time, which again increases your future expected returns. So another slip up I can see with investors when it comes to these types of market conditions is significantly underestimating the volatility of the markets in general. I mean, we're down 20%. around 20% from peaks we've seen just a month ago, but do not get the impression that the markets cannot fall another 20%. Just because the markets have dipped this much does not mean that the volatility is gone. In fact, it might not have even been started. And if you're buying equities right now, which again, buying equities at lower price points, especially at regular intervals, has no doubt proven to lead to higher returns in the future. However, you have to be prepared if you're buying right now to put it bluntly, look like an idiot over the next, 12 months, 2 years, because they could easily go 20 or 30% lower. Don't automatically assume that a 20% dip in the market is all we're going to see. They can go lower. Historically, they have gone lower. And we've just witnessed today a 4.5% gain. Now we're sitting in the red on the day, and we witnessed 6% drops in the index for multiple days forward. There is way too much going on right now globally, especially in the United States when it comes to tariffs, to ever make the assumption that this is all we're going to see. So if you're buying equities right now, just do so with the understanding that they could fall an additional 20-25%, especially if you're investing in individual stocks rather than a broad-based index. Individual equities, when you buy them, you are exposing yourself to way more volatility rather than buying a broader index. Now, depending on the individual equities you invest in, your volatility actually could be lower. But again, you need to just understand the concept that no matter how cheap you think stocks are right now, they can get much cheaper, especially if this situation persists. A company that was trading at 27, 28x earnings, dipping to 19x earnings. It might seem like a bargain now because it's the cheapest the stock is traded at in 5 years, but it can get much uglier. Now, I'm not suggesting that you don't go out and buy companies at regular intervals on these dips, but just do so with the acknowledgement that it could get a lot uglier from here, and you're just going to continue buying when that situation happens and they do get even uglier. What happens when you start buying equities right now and then it gets more volatile and you don't stick to your strategy? You start trying to time things, you start trying to panic, you start thinking you made a mistake 10% ago, so now you're going to sell. Stick to a strategy. Understand how truly volatile the markets can get from here, and ultimately you will come out ahead. It just might take a little bit longer than you imagine. So the final point I want to go over is expecting immediate rewards for good behavior. And this is a thought process that a lot of investors have, especially ones that have not been through prolonged bear markets. The stock market is a situation where in a bull market, you are often rewarded for every good decision you make and every bad decision you make. Now, don't get me wrong, there are still numerous poor stocks during bull markets, but generally you are rewarded even with suboptimal decisions in bull markets. And this is obviously something that is very easy for investors to process. If we buy a suboptimal stock in a bull market and the markets are up 30%, but our stock is up 10 or 15%, this ultimately doesn't hit investors as bad as in a bear market when we buy a strong quality company and it's down a bunch. We start to believe that we're doing the wrong things because we're not getting immediate results. And what I can tell you right now is if you are buying equities during a bear market with the expectation that you should be rewarded immediately for the good behavior you are making, you are going to be thoroughly disappointed if this persists for very long. You can make every single right decision possible for the long term. You can buy quality companies, you can dollar cost average into those companies, you can do absolutely everything by the book, and you may not be rewarded for years. That is ultimately the situation a lot of investors have been in historically in bear markets, and eventually it weighs on them enough that they just give up. See somebody invest during a bull market, we finally hit a bear market, they continue to do everything right, yet they aren't rewarded over the course of a year, 18 months, so they effectively just give up. Plenty of investors do that, and it is very important that during times like this, you trust your process over the immediate results. Doing everything right now and expecting results in a 6-month time frame, a 1-year time frame, is going to set you up for failure the exact same way that it would set up somebody who's looking to lose weight for failure if they expected results in the first week. I mean, it's just not going to happen. It could happen, but you have to be prepared for it to not happen. So there is no doubt that bear markets, they will test your patience, but just don't let them test your intelligence overall. Just because you have not seen immediate results over the 6-month time frame, a 1-year time frame, does not mean you are doing anything wrong. Your expectation should be to accumulate high quality companies, high quality indexes, and buy them over the long term. So if you're sitting there right now, you're rebalancing properly, you're buying quality companies, you're ignoring the noise, don't expect results immediately. Expect to be uncomfortable now in order to reap the benefits over the long term. The more you prioritize short-term results, immediate results, the more mistakes you're going to make. And as the saying goes by a very popular investor, your portfolio is like a bar of soap. The more you mess around with it, ultimately, the smaller it's going to get. That's it for the video, everybody. I really hope I brought a different perspective outside of just the normal videos you're going to see surviving a bear market. I think I brought, a bit of uniqueness to the table here. If you liked it, head down below, subscribe to the channel, like the video, and drop a comment. Let me know how you're weathering this current storm, what you plan on buying, what you plan on selling, and let me know what you want to see in future videos. As always, everybody, join that newsletter down below. It's got that bonus report, 3 companies I really love in 2025. They're all doing very well despite this harsh drawdown, and we'll see you next time for more great investing content.